So this presentation is on historical VaR, and it is useful for those who want to get a basic understanding of VaR and how exactly VaR or value at risk is calculated using live data, which we will be covering in the subsequent slides. Now, VaR is the single most important measure of risk used in the domain of risk management, primarily by banks in order to quantify their risk on the balance sheet and determine their risk capital. It can also be used by portfolio investors and investment banks for assessing the risk that they are carrying on their portfolio. So let's move on to the next slide. So there are various types of products in the marketplace, such as bonds, stocks, derivatives, which have flavors of options, futures, and swaps. And what is common across all these products is that they have inherent financial risks, which include market risk, which is change in value due to change in prices of the underlying, credit risk, which is primarily the default risk, operational risk, which is failure of internal processes. Now, in this walkthrough, we are only going to look at market risk and more specifically, how exactly market risk from the point of view of VAR is calculated using the historical method. Now, what is market risk? It's basically the change in the value of portfolio due to the change in the value of the underlying assets which comprise of the portfolio. So, to how do you determine market risk? You need models which involve pricing and statistics and correlate these to market risk factors such as volatility and covariance and variation. Market risk is primarily across four categories of products, which includes equity prices, which is what we are looking at in this presentation, interest rate risk, foreign exchange risk, and commodity price risk. Now, let's start with what exactly is VAR or value at risk. It basically gives you a single number to quantify exposure to market risk. And it's the most commonly used risk measure with solid background models for assessing and quantifying the VAR value. Now, what it defines is it's the maximum loss which should not be exceeded during a specific time period with a given probability, or in other words, a confidence level. So, there are 3 points or three aspects which are important here: maximum loss, specific time period, and confidence level. So, how does this translate into literals? If you see the point down, which is var 0.95, 0.95 being the subscript, and in parenthesis 5 equal to $10 million, it means that one is 95% sure that over the next 5 working days, the losses would not exceed $10 million. In other words, there's a 5% chance that your losses can be more than 10 million due to the occurrence of certain events in that 5% loss window. But what it doesn't tell you is what would be the total loss in which can happen if you breach the threshold. Now remember one thing, that VAR is basically a frequency measure. It's not a severity measure, it's basically a threshold. And there are three methods used for computation of VAR. Historical bootstrap method, which is what we are looking at in this deck, variance covariance method, and Monte Carlo simulation. I will be covering the variance covariance method and Monte Carlo simulation in subsequent presentations, which will be released shortly. And all of these models are based on estimating volatility. And historical VaR, from an academic standpoint of view, is a non-parametric method of VaR calculation. Most important, the underlying hypothesis is that the pattern of historical returns is indicative of future returns. Now, what are the steps involved in calculation of historical VaR? So, it's important that you should get a handle on this because this will help you to understand the worksheet which I will present shortly. First is you need to collect the data on the concerned variable, which can be equity prices, interest rate, exchange rate, or commodity prices, depending upon what type of portfolio you're intending to analyze from a risk perspective. For example, if you've got a portfolio of gold, so then you would need to look at the gold prices. Data can be collected on daily movement, let's say over 2 years or 1 year. Now, having collected this data, what you can do is you need to calculate the percentage change, CT, which is nothing but PT, which is the price today, minus PT minus 1, which is the price a day earlier or a period earlier, divided by PT minus 1. So, this gives you the return over a 1 day or one working day period. And these set of returns you need to sort it in descending order. Worst coming first and going all the way down to the best. Then you need to create bins. Now I'll explain to you in the worksheet what exactly is meant by bins because they logically lead to calculation of the frequency which is used for building the histogram. Having calculated the frequency for certain bin intervals, you can calculate the frequency percentage and interpolate the data where necessary, which I'll show you what it means in the worksheet. And then you can finally calculate the VAR and put it on the histogram. And you can also use the percentile function in Excel to cross check whether your frequency table and method of calculation is accurate. Now, here's a worksheet of historical data for Reliance Industries for the period 2nd June 2022 to 2nd June 2023. So that's 365 days. And the minimum return is minus 7.2% for a given day, and the maximum is 4.31. So this is the date, and this is the price which I have, which is the closing price which I've got. So return is calculated this way. So it is today's minus the previous days divided by the previous date. So that gives me 2.03%. Copy the formula all the way down. And then you, having done that, you sort these values in ascending order. Now, having done that, the next step is you need to build a frequency table. How do you do that? First, you define the bins. Now, if you notice over here, the minimum value is minus 7.2% and the maximum is 4.31. So, I've taken the minimum over here as minus 0.10 and the maximum is 0.10. So, all your observations fall within this interval. And then you need to calculate the frequency. So how do you do that? You basically select this range. Please look at this carefully. And then you put the formula. And the formula is E11 to E258, which is your base data. And then it's got J11 to I11 to I31, which is your bin range. Do a control shift, enter, and you'll get the frequency. Now, if you note, there are 248 observations because there are holidays and non-working days in this data bank. So, which corresponds pretty cool to 250 working days across a calendar year. Now, frequency is calculated by this divided by the total, and this way you can calculate across the board. And having done that, you can build this data histogram. So, the x axis is basically the bin ranges, and the y axis is primarily the frequency. So, you get this wonderful near about normal distribution using the frequency table. Now, we need to compute the confidence the bar value for the confidence levels 5% and 1%. So how do you do that, right? So using this particular data, if you see the frequency build up over here on a cumulative basis, you know that 5% happens between 0.048 and 0.214, right? So it's not falling exactly on a particular bin. So I can't say, for example, that my VAR is 2%. It has to be little less than 2% because it's falling within this interval. So I need to do an element of interpolation, and that's what I've done over here in this formula. For those who want to know how best to do this interpolation, you can pick up any book on statistics and figure out in the chapter dealing with interpolation how you need to calculate that. Now, using interpolation, I find that my var value is minus 1.998%. And over here, if you see, I've calculated it as minus 1.99 using the percentile function, which I spoke about a little earlier. And that's pretty much matches with what I've got from the frequency table. So that's good. And using that, I can plot the 95% arrow over here on this histogram and show where exactly it lies and what the losses would be beyond that point in the normal distribution. Likewise, you can calculate the VAR at the 1% confidence level, which comes to minus 3.02%. And if you use the percentile function, it comes pretty close to minus 3.03%. So, what does it mean? It means that with a 95% confidence, we can say that a daily loss on Reliance share will not be more than 1.99%. So, if you invest 1 lakh in Reliance, your daily loss will be with a 95% confidence would be 1990. Likewise, at a 1% confidence level, it would be, or 99% confidence level, it would be 3030 rupees. So that's pretty much how historical VAR is calculated, what it means, and what are the steps you need to do, how you need to collect the data. Those of you all who are interested can look at some other companies as well, calculate 2 years data and actually see how that builds up insofar as your VAR calculation is concerned. So if you have any questions or something, you can post them on the comment section in this channel. Thank you.